Right now, the United States of America is the world hegemon, right? We're the global police, we're everywhere.
The currency though, but it's a little bit shaky on the world stage. What happens is nobody in the country believes in the country anymore. So you lose the economic belief in that, like if you buy US Treasuries, well, to hell with US Treasuries. Like everyone starts to think that way, and that is the problem for the dollar. NVIDIA right now, market cap is worth roughly $3 trillion. And all the gold in the world that we know about and can quantify in the central banks, which are the biggest holdings, is $3 trillion.
Wow.
Like that seems odd. All right, welcome to the CashFlow Quest. We wanted to kick off today and have some fun chatting through the economic challenges / uncertainties. And we kind of wanted to have a cup of coffee, Tide's having a Celsius. We're just going to enjoy an open mic dialogue through everything that's going on. We are locking rate on our loan either today or tomorrow on a $16 million loan. So this is all really relevant. It's kind of like insider to what we're kicking around in the office. So we decided to lay this stuff out. So yeah, disclosure, this is just our opinion. So take it or leave it. But we are learning and we're having fun learning. And so we wanted to share it with you guys. So let's kick off. We were just kind of having a, sit down chat over the fact that tariffs are live. We got a lot of volatility in the stock market going into that, uncertainty with tariffs. We have bonds and US Treasuries. We focus heavily on the 10-year Treasury for our rates. And so there's some bumbling and movement up and down there. So why don't we kick it off on tariffs just because we were having fun with that. I think I'll lay out the broad strokes, but you guys are doing a good job. So Trump is trying to strong arm the rest of the world where we have historically been weak on the negotiation front of let's say long term. There has been a move over the last probably 30 years plus to offshore a lot of jobs to China. So we lost out on a lot of broad investments and a lot of money went there because they could produce goods a lot cheaper. So then that evolved over the long haul to where we really don't do a lot in-house anymore, which also strategically speaking leaves, I'd say, a Trump feeling vulnerable to the fact that we don't produce a lot of needed goods here for our population. So I'd say that's kind of where I see it from is we need to bring at least the mainstream goods and services that are an absolute necessity to support American life. I think he's being defensive of that and wanting to bring those baseline jobs back so that we are self-reliant and self-sufficient over here in our little island.
Yes. Yeah. And I think too, you touched on it really well, just like the lead up into the 90s and early 2000s of globalization and where we were generally a net importer and we exported, not a ton, but it was more like we're exporting American culture and our consumerism and all of that. And so, when you look at all these trade deficits that we have with all these other countries, on paper, we're a net loser. And so I think COVID really brought that to light when supply chains really dried up and showed our lack of resilience internally, within the US and our dependence on many other countries for basic necessities. And Trump coming in is really, he's talked about his favorite word being tariffs. I think to your point, it's really a negotiation tactic. But he is using it in a very aggressive way, for lack of a better term. And what that does to the markets like certainty. And so when markets are uncertain around this reciprocation trade of reciprocal trades and how's Trump going to act? What is he going to say? And then on the other hand, how are other parties, other countries going to react? And people don't know. And so that's why you saw the market is selling off in a large way. I mean, Monday was the largest sell-off in the NASDAQ since 2022. All of February gains have now been washed. And, it's not a good time to look at your 401k. But I think it's a combination of two things. One, it's the uncertainty in the market. The second that can be argued is that the market has been artificially propped up by just cheap money. And then all this government stimulus over the last handful of years where people are just essentially getting, free checks from the government to go and spend, that artificially props up corporate earnings. And people are looking at the stock market and saying like, this is, you look at valuations, it looks like it's way overheated. And what really prompted the market to sell off was Trump's comments on Sunday, where he basically indicated that he's not so focused on the stock market as many people believed as he was in his first term. The consensus was that
all-time highs.
Exactly.
If you're Trump, you're going to go out there and swing around some big ideas / big power. If you can get it done right now, now's not a bad time if the market's at an all-time high.
Well, also, we were just talking about this as a negotiation tactic, right? So you're in negotiations with different countries. You don't want to, go and have interviews and be like, oh, we're not going to let it go into a recessed market and we're going to do anything to save that. He's basically posturing to every country that we're doing this little trade agreement and tariff threat of, if we go into a recession, we will over these. And people are like, not really sure. He's put out these different tariffs and then retracts them when he gets what he wants. Hey, I don't like what's happening over here. Mexico sends 10,000 troops. They say that they're going to do X, Y, and Z. Then that tariff, okay, we're going to push it another month. He's been kind of,
he's flexing on.
He's been giving different tariff threats and then removing them when he gets what he wants. And then now there's kind of this second round. And I think 100%, you're 100% right on the fact that there's volatility in the market because of people being unsure, and the market doesn't like to be unsure. It wants to have nice, easy plans for the next 10 years. And right now they don't know. He's a wild card. What's going to happen? What's the long-term effect of these different things he's doing? But I do think it's a negotiating tactic.
Mm-hmm. Oh, fully. But that's really all it is. And that's all we have. What other tools do you have when you're doing mass trade deals across the world?
Well, so I think one of the talking points is the concern that you were just talking about reshoring jobs to America. There's this kind of thought that's going around that he's basically going to intentionally bring all these jobs back, but like at the detriment of our trade deals with our trade partners permanently. Like, we're going to cancel all of this. Right. But I don't think that's really what's happening. I don't think he's...
Dude, it is.
No, but I would argue that he's doing that in some situations, but it's not like I'm going to completely bring everything back to only U.S. manufacturing.
I think that's I wouldn't say everything, but I think the big needle swinging companies that are overseas, I think he wants them back. Like Apple, I think I just saw that they're going to put $500 billion and build a whole nother plant here.
Yeah. So
it's like, that's a lot.
Yeah. I don't think, now this is just my opinion. I think if you look at it from an economic standpoint, there are some benefits to our economy of leveraging the affordability and expedition of product development and manufacturing in other countries. So I think from a military standpoint, like obviously you want the high-end processors, semiconductors, chip factories being built here. You want things like the iPhone.
But just to be clear, that's not happening.
That's yet. What he's posturing to do, right?
Yeah, but that's not happening yet. So like everyone, I think, is freaking out early. If Apple and everyone came out, let's say, and Taiwan Semiconductors and all these places that now have started leaning back into the US, then if they were like, sorry, we cannot do it, it's not going to work, I think that then his strategy would have to change, but it's working.
Right now, the United States of America is the world hegemon, right? We're the global police, we're everywhere.
The currency though, but it's a little bit shaky on the world stage.
But the quickest way to end that would be to basically say that we're not going to work with any countries and bring it all back. I think that would, then everybody would definitely stop using our currency. A lot of the benefit that comes is the fact that we're manufacturing and working with all these different countries.
I think too, just America from an investment standpoint, we are the shining star right now. So like on a relative basis, like this is the best place to place capital. And so we have a lot of leverage from that standpoint. But if I really think about what Trump is doing and just the overall, while this is happening is due to our debt in the way, and then also combined with him trying to pass this tax bill. So how is he going to fund this tax bill and the budget reconciliation that just went through the House? And a big part of that is the tariffs. And so it's important for him, this short-term pain for long-term gain is that, hey, these tariffs are important for us. We are running we have too much debt, like $37 trillion. I'm going to cut the waste, continue to cut where I can any fraud and waste and abuse, and try to tighten up my belt, use these tariffs as a way of generate income to pay down our deficits, pay down some of our debt, all while I'm trying to give this tax relief to the US citizens, which is going to reduce the tax revenue. And so he's playing with all these very delicate strings. But I really do think why is he doing this? What it all boils down to, I really do think that it all comes down to the debt and the insurmountable amount of debt we have, and just the amount of interest payments that we have to pay on that debt. That's higher now than all of our other spending. It's exceeded defense spending, right? All the other categories. And so that's where I think it's really boiling down to. I think he sees like the writing on the wall, and I think Elon sees that as well. And he's willing to sacrifice Tesla. I mean, Tesla's down tremendously, like 50%, right? And they're willing to make these huge sacrifices because they see the writing on the wall that we need to get our house in order. Otherwise, we are going to not be able to cover our debt. And that's going to prop up Treasury rates. That's going to devalue the dollar. That's going to have people where they don't want to settle in dollars and they're going to continue to settle in gold, or they'll settle in another currency. And then that's where you can get into a situation where you could have like runaway inflation and all of those other considerations. So I really do think that like all of this stuff that he's talking about, it's due to the debt. And that is the big reason why they're really focused on it. And that's just my own personal opinion.
I agree. All I'm trying to say in this is that I feel like the media is making it out to be a bass guitar that he's playing. And I think he's playing a harp. I think there's a lot of different functions. I don't think he's just doing like one big, I'm going to bring all jobs back to America. I don't think he wants to do that. I think that would hurt America because it would inflate prices to the consumers. It would negatively impact businesses that are headquartered here. There'd be it would break a lot of things. And I think that's one of the talking points on one side of the aisle to make him look bad. Oh, this is going to cause inflation. This is going to cause this. And I think he's posturing, he's negotiating, and I think he's doing a lot of things. I think it was on Tucker Carlson, they had a health insurance person that was speaking, and he was talking about that $1 in $5 spent on debt is due to health in America. And I think that that's why he's brought RFK, and that they're doing all these things to lower, all of these health concerns. We're going to change the food. We're going to change the processing. We're doing this. I think he's doing everything he can to attack debt. I agree with you 100%.
And it's like the top 5 things, he's hitting all of them square. Every single one of them that could actually move the needle and save us money long term and get us healthier as a country, which will reduce costs. Elon mentioned either yesterday or the day before that, like, he believes this to be an existential crisis for the US. We either make it or we don't through this. That's why he's so, focused on Doge and the Department of Government Efficiency. Because it's like, if we don't cut where there's tons of waste, we won't make it. And that's where like the vulnerability of the dollar is at risk. I mean, we are the current hegemony, but like BRICS are starting to settle in gold, And so there was like, remember Trump came out and said, if the BRICS nations create a currency, like we'll just tariff you 2-3x or 200% or whatever his comments were. And like Jim Rickards, I follow him, and he's like, well, they don't need another currency. They already have it. They're already settling in gold, and so they're literally changing hands on any discrepancy on their trade deficits. They're settling in gold. So there's a lot of maneuvering to where the stronger you make us as a economic power, and that's why I believe I'm with you. Not everything's coming back. It doesn't need to have everything come back, but we need core. We need like core foundational security, nowadays, computer chips, all of the main components, because we can't protect Taiwan. Like there's certain things that are like really pot stir things that are going on in the macro, to where if we onshore those particular pieces, now the dollar and the treasury bonds and the demand for allocating capital inside the US borders is going to get really strong. And then from there, we actually have a platform to build on long term where we can start to pay down the debt. We actually show proof. Actually, I thought a cool Ray Dalio interview the other day was that if you show proof that you are going to take the budget seriously, which has sort of been a joke for like the last 50 years.
Yeah.
You know, the government has literally been managing their checkbook like a broke idiot.
Yeah.
They're
just to interject a point. They had the primary operating system for their accounting is this thing called PAM, and they didn't have to put any information. They were basically sending blank checks. This was Elon was talking about this on Doge and Joe Rogan, that literally they didn't have to put what it was for. They didn't have to put the date. There was no GL coding breakdown.
Yeah.
So like it was just blank checks. And there were situations where a guy would be in charge of allocating billions of dollars. He would pass away and it would be like a 10-year contract, and they'd just be continuing to send the money out the door.
That's called washing money. That's called like you're stealing money. People are taking money and riding this machine that's like completely just rogue, you know?
I think that it's 90% that. But I also think it's just a lot of it is due to ineptness. Like it's not always necessarily due to intentional malice, but when the machine gets so big and nobody's
managing it,
the parent left and you've got the teenagers running the house and everything's breaking. You know, the fridge doesn't work, the light bulbs are out. That's what's happening.
But so with that in mind, what happens is nobody in the country believes in the country anymore. Mm-hmm. So you lose the economic belief in that. Like if you buy US Treasuries, well, to hell with US Treasuries. You know, like everyone starts to think that way. And that is the problem for the dollar. Long term, you take this out. If nobody believes in the US being an economic superpower, where does that leave you?
Yeah. And not even just US buyers of treasuries, but foreign buyers of treasuries.
Governments.
Yeah.
Exactly. Huge chunks.
I think that's the single biggest mistake that the previous administration did, was the way that they handled Russia and basically like seizing all of the money, putting all of these sanctions on them, where it was like, basically it's all of Europe still needed to buy their oil and gas from Russia. They were still making. So then what are they settling in? They're working through, they basically circumvented American dollar and currency. And I think it was a really bad look, because now every nation's like, well, if we piss off America, they're going to freeze our assets and basically not let us operate.
Not only did we freeze them, we like
stole them,
reallocated them to fight a war.
Their enemy.
It doesn't get any worse than that, honestly, like from a economic war standpoint. But yeah, that's so all in the mix. But now, okay, so then it seems as though like this big cruise ship, that they got going in that direction, he's now full left, hard to port.
Yeah.
And he's going back and like having the Zelensky meeting, like strong arming people back in line to where like, hey guys, we understand that you don't agree, but like we're not willing to let the war continue with millions of lives being lost. Like it's crazy that they want to keep going given the result that's already occurred.
Yeah.
Like it's wild. It's like setting aside that geopolitical thing, like the fact that they're willing to just keep throwing bodies at it is unreal to me.
Yeah, and it's sad. But let's switch gears a little bit, because I think you touched on it right in the beginning of opening up, is that we're managing risk, right? Why we care about this stuff so much. It's not because we're political analysts or anything like that, but we look at the 10-year treasury. We're locking today, a $16 million loan. And so we're heavily focused on what treasury rates are doing as we're trying to buy deals, price deals, and then de-risk them by, rate locking. And so you had CPI that came out today, 2.8%. So it was a little bit below consensus, which is great. And then I know you were following the treasury auction pretty closely this morning, which I think concluded. And then you had the unemployment numbers last week that came in a little bit like higher, right? So you have unemployment that looking like it's starting to creep up. You have inflation that seems like it's starting to come under control. So we're starting to get into this rosy lock type of economy. And then the tariffs are the wild card. Like, does that increase inflation and then throw the Fed completely off course for this soft landing? Does Trump just completely, throw us into a recession? But I think right now, if you're a real estate investor, like I really like this time. I really like the 10-year sitting at a high 4.2s, 4.3s. Hopefully it goes down to 4.1, but I mean, we're going to lock at an amazing rate. You know, when we first tied up that deal, I think the Treasury was around 4.5, 4.6, 4.7. So we're really stoked about that. And that's really why we care so much about this stuff, is like we manage a lot of money for our clients and we're buying deals. And so This is like a really great time for us where it's like, oh, let's take the bird in hand, rate lock, have an amazing rate for 10 years, fixed rate. And, you know, we're in a really strong position for our new acquisition. So I think if you're a real estate investor, this uncertainty, I know it's terrible, but I've been talking to some of our clients about this. The uncertainty in looking at your 401k right now probably doesn't feel very good because you're seeing the stock market sell off pretty dramatically. But what it's doing is also driving down Treasury yields, which is very advantageous for real estate investors and guys and gals like us that are managing risk live and rate locking at really long-term great interest rates.
What I think is really beautiful and a great tie into our space is, let's just use Tesla for an example. I think Tesla is a really innovative and smart company, and it's down like 41% this year. Mm-hmm. I mean, we have friends.
This year? When did that start? Beginning of the year?
Yeah.
Okay.
So we have friends and family. Hell, I'm invested in Tesla. And so trailer parks don't do that.
No.
I mean, unless it burned to the ground because of something catastrophic, life event, God event, natural disaster, it's not dropping 41% in value overnight, and I think that's the beauty of having some fixed asset in your portfolio, investing in something that's stable. And that's why we kind of pitch this. It's like wealth is developed over time, and it's a moderate place, but it's growing, it's strong and stable, and it's not up and down.
The whipsaw effect. And that's another thing too, like the illiquidity premium, right? So you get a premium for your money not being liquid, right? Right. And the other benefit that you get outside of just outsized returns is that you don't have to go through this song and dance of like, oh, what's the market doing? What's Trump doing? That stress and volatility for many folks. Like if you're a young person, sure, throw it in there, set it and forget it. But most of the people that I talk to are in their 50s, 60s, 70s, right? And so a 20% drawback, 10% drawback, 5% drawback, that's a lot of money. And they see that, those big red numbers and that hurts. Where in our space, they're still paying rent, they're still producing that monthly income, and they're going to drive value over time.
The demand for affordable housing
is huge.
And the ability to bring a new product and new supply in affordable housing and manufactured housing online is never probably been any more difficult than it is now to like develop new parks. And we know a few people that are developing, and they are able to sell the homes, no problem, but it's not cheap anymore. It's expensive. So the demand for our product is really great. So our rental rates are increasing real time because the demand's heavy. And then you have a bunch of capital that is seeking this like security in real estate, hard assets, hedging inflation. And then we don't all sit around looking at a ticker of the daily values of these communities. We're more focused on, hey, how much does it cash flow monthly? So like the focus on cash flow is so much better than the focus on the equity valuation real time. And that's, why we particularly love the space.
And you don't sacrifice returns. I was talking to one of our existing clients, and we were going through just kind of overall returns and, our track record and so forth. And he made this comment that, well, if you invested, we were talking about, we started in 2009. If you invested in 2009 in the stock market, the same amount, it would be way greater than anything in real estate's return. And I was like, I didn't challenge him on it, but I was like, oh, that's interesting. And so then I just quickly ran through and calculated the returns and threw it into Gronk or ChatGPT. And I said, reinvest dividends, right? And no, we exceeded it by 6%. I think the average annual return from 2009 all the way to 2024, I had it stop, was 14% or something like that. Where we're, I won't quote it over this. 20. Yeah, exactly. Yeah. Right. We exceed that. And so that was one of those comments where it's well, it's really not. And so what is the difference between those two returns? What are the trade-offs? One, stock market's liquid. You could sell it. You don't get any tax efficiencies in the stock market. And then, from 2009 all the way to now, you're going to have to be dealing with all the headache of you looking at your Charles Schwab, your TD or your 401k over those 15 years, I'm like, oh my God, it's down. Oh, now it's up. And it's like that roller coaster. And I started my career on a trading desk and grew up in that kind of environment. And I just realized I didn't really like it. And I didn't have any attachment to tickers and trying to follow it. I just kind of felt exhausted. And I was like, no, I just would rather focus on something that I believe in, something that's real, that I could see, understand value. Like we just got back from, all of us at different times being in Texas, seeing some of our deals and being in the market. And I just rather say, no, I get it. I understand it. I see the value here. I could underwrite it. I could talk to the property manager, sit on site and be like, no, this is a real value that's going to generate strong returns over years, and then set it and forget it. And I don't ever have to think about mark to marketing my balance sheet and my, my portfolio. And so that for me, it works. It works for a lot of other people, but some people, they like the volatility. They like the uncertainty and the excitement.
They like the dopamine that they get from pain.
I kind of view it as like, unless you're a Buffett style guy where you understand the price, and the price to earnings, and like understand the value that it actually has in the world and its production and productivity. I understand that type of investing in like Nvidia and Tesla and riding this wave. That's to me like going to Vegas.
What's Warren Buffett doing right now with his money?
He is sitting on more cash than he ever has in history. So it's just an interesting point. Yeah. Yes. Warren Buffett is sitting on like several hundred billion of
350 billion.
And he continues to basically sell off certain sectors or certain stocks that they hold because it's like all time high. So he did this like last maybe 6 months, so he's been doing it. And then he does like his end of the year meeting. And so long story short, he just thinks the price per earnings and like how much you're buying for these tech stocks across all of those different platforms, AI or just regular tech. He's just unconvinced that they are going to produce as much in the returns that they're pricing in now for the future. So the price to earnings on Nvidia is like 50 to 1.
You basically pay $50 for $1 of earnings.
Yeah, that's insane. So the real estate, a 5 cap, which is a great deal today, like a really high quality asset today is a 5 cap, given where rates are roughly at 5 too. So you
pay $20 for a $1 of earning.
A 20 to 1, price to earnings ratio. So for what you're getting in that 40 to 50 plus to 1 price to earnings ratio, he is unwilling. He's like, I'd rather take the money off the table and sit on the sidelines so that it goes back when things correct, if and when they do, he can then go in and buy a ton more. So with what Tyde's mentioning is Nvidia right now, market cap is worth roughly $3 trillion. And the entirety of the central bank's gold, including us, US, China, like the big, huge economies of the world, central banks are all buying gold at unprecedented levels.
Yeah, it's probably going to breach 3,000 here pretty soon. It's up pretty big today.
But at current valuations, call it 2,900, 3,000 an ounce.
Yeah.
All the gold in the world that we know about and can quantify in the central banks, which are the biggest holdings, is 3 trillion.
Wow.
So that's just one company on the US
that makes chips.
That makes, computer chips.
It's not the whole industry.
Just one company, is worth what all of the world's gold holdings in central banks is worth.
It's a bubble.
Like that seems odd.
Yeah. And you listen to that Ray Dalio conversation and then other conversations that we have with, high net worth folks that ran hedge funds or very sophisticated individuals that we have the pleasure of knowing, not Ray Dalio, but they're buying a lot of gold. And so when I'm talking to them, like what are they holding right now? They're holding a fair amount of gold, which I've never heard of.
When like my JP Morgan private banker called me and he's like, man, how'd you know about gold? And he's like, we're doing all sorts of creative like funds right now around holding commodities and gold and this and that. And it's funny because where are these, the people that have lived a meaningful amount of life and have the track record and the history to look back on and have the hindsight, which like us in our 30s don't have. I'll be 35 next week, so I'm getting up there, guys. And I'm kidding. I feel really young. But anyways, these guys that are like Dalio 75.
Yeah.
Buffett's 95, right? What is he? 93, 95?
Something like that.
Yeah.
So like those guys with optics and hindsight, they understand value. Now, Buffett's not a gold guy. So him and like the old time debate on gold is really funny. You can watch these videos on Warren Buffett's conversations over the years and Dalio's, and they contradict one another, but they've both done really well.
Mm-hmm.
Buffett being though more focused on something that produces a return and, and so that it's live and it's, obviously he loves stocks at a discount, however they come to be. But, it's just a really interesting moment in time. The uncertainty on the global demand for fiat currency. Like if we boil this whole thing down, Trump's got this tiger by the tail, which is the dollar. And you got to figure out how to get this thing to sort of calm down and settle. And everyone sort of believes that the tiger's not going to bite them.
Yeah.
And the dollar is not, it's scary right now. You don't know what's going to happen, which is the inflation concerns.
Mm-hmm.
So then the Treasury, nobody's bidding on Treasuries. Well, it's like, that's literally how we fund the government.
Yeah.
So now it seems like it's settling, even though the tariffs are uncertain, but like, things are going to come around. And the short term is like, what's going to happen? But I think over the next couple of years, it'll all start to make more sense. Yeah. And it's just fun to see,
That's why I think like what we're talking about this moment in time where the treasuries are at. It's like, hopefully, like this is where I'd want to be locking, because I feel like there's way more downside. And so you would look at a downside that treasuries go higher than they go significantly lower without a recession. So I think the only way the Fed has wiggle room for sure. Where they have the Fed funds rate, I think it's like 4.25 to 4.5. So they have wiggle room to be able to cut. So I think that they gave themselves the ability that if we do go into recession, they can rate cut to help, bring us back up. But they don't want to rate cut too fast and then us go into recession, and then they have to do quantitative easing or some other measure to then kind of bail us out. So I feel like I do kind of feel like we're in this little Goldilocks right now. And I really like where the treasuries are at. I like where some of the economic reports are coming in at. I just hope that tariffs, and I don't believe that they're going to spike inflation. I really don't. I don't think it's going to be. And you can go ahead, because I know we were talking about that before we jumped on. I don't think that the tariffs are going to really drive inflation as much as people think that they're going to drive inflation. I really think it's a negotiation tool. And it's like, okay, if we put some, steep tariffs on Mexico, which I think the aluminum and steel is live today on Canada, all countries but Canada and Mexico, and we import a lot of aluminum and steel from Canada. It's live today, 25%, but let's just say like avocados, right? So if we import, some tariffs on Mexico for avocados, well, we make avocados, right? So then we would just buy more of our avocados. And maybe what is that price?
Well, those
it's
things that we bring in from those places will go up.
And you have options,
but that's a basket of goods.
Correct.
Versus, so it's like, yes, there maybe be a couple of ripples and some spikes in certain things, but like there's not that much Mexico and Canada provide that's going to completely crush us across every sector.
Yeah.
Okay.
Let's go.
I don't think it's going to completely crush us, but tariffs by design are immediately inflationary, right?
Yeah.
And I'll use an example right now in our own world. We're getting letters from the different manufactured housing companies.
Do we buy from Canada?
That the supplies that they use to manufacture the homes have gone up. And now they're doing every 2 or 3 weeks, they're having price adjustments. So that's an immediate effect.
Yeah.
That's inflationary, right?
Yep.
And so I'm not saying that this is going to be a permanent inflation cause, but in the meantime, it's going to be inflationary. And I think even Trump alluded to that in his address to the nation.
For sure.
Well,
we have systems that are used to this. We have supplies that are coming in. We're used to getting them at a really good rate, a really good price per unit, whatever it is, into our country. So we need to adapt and shift. And that is a short-term pain point for sure.
So I wouldn't be surprised if over the next 2 quarters, we see inflation spike if we're actually effectuating these tariffs.
If inflation spikes, treasuries are going up 100%, 100%. That would be my concern. If inflation
I'm
starts
on the pod,
if inflation starts to spike, treasuries are selling off because it's going to completely pivot what the Fed, what people are pricing in. That hopefully now they're pricing in. Now the Fed will go and do. I think they're even pricing in 4 cuts. It's like 30% probability, so it's really low. But like 2 cuts, I think it's like a 70% probability. So if you get one bad inflation report, you're going to see the Treasury sell off. This is just my opinion. I'm saying this kind of like selfishly from somebody who is trying to lock deals and get deals that make sense and so forth.
So the question is,
well, maybe that's why Trump is, I'm just thinking out loud here. Maybe that's why Trump is like leaning into some of the fear, because then people hold their money. Because if you stop the velocity of money,
correct,
you won't have the same amount of inflation, because now you're just going to like a smaller amount of consumption. You know, like you're not consuming the huge swaths of like consumer products across all of the normal things that are in movement, but like everyone stops spending as much money.
Yeah.
So it could be a reason why he come out and kind of say that.
It's already showing like Kohl's, like, you know, which is just a retailer, but they got hammered, right? And in their earnings report, they talked about how people are spending less, airline travel's down. So
there you go.
Yeah, it's just consumer confidence, consumer spending. So I do think we need a little bit of that. We need I don't want to say a recession would be good, but we do need I think there needs to be a little bit of a cleanse, to an extent, because if you just keep overheating this economy, you just keep kicking the can down the road. And then the eventual recession is even more catastrophic than hopefully this, more like, hey, let's pull back. You're going to see some volatility. Let some of this tariff stuff play through. And then maybe we get into this place where it is a little bit of a rosier situation. And
it just kind of clicked for me. If you slow the velocity of spending across our entire country, right now, we're not building a ton of homes. We're not like, there's a lot of slowdown on the construction side.
100%.
Meaning you're not buying a bunch of lumber. Like there's certain things that are really not moving at peak like rates.
Mm-hmm.
So if you slow everything down, make these massive adjustments now while we're not in the midst of a big ramp up in production.
Yep.
You could potentially reorganize while everything's more calm and quiet,
mm-hmm.
and then creep the throttle back on, and things should normalize without as much damage occurring.
Yeah.
Because we have a unbelievably high debt amount that you can't, like, that's the core issue here.
Mm-hmm.
We have to remember, like, the goal should be to figure it out, bring it in house, and pay down the debt.
Yep.
And cut costs everywhere we can. It's no different from like if you were doing a big project on your house and you run out of money, like you have to stop.
Yeah, exactly.
Like it's not that hard.
Yep.
So yeah, like, oh man, well, I really want this super slip and slide down my roof and into my pool. It's like, no, man, you ran out of money.
The federal government had slip and slides all over the roof.
They had money shoots, man.
I'm making the call right now. I think we're going to see some bad inflation reports. Not drastically, but I'm just saying it's not going to be a positive report. At least one or two over the next 2 quarters. I think we're going to get some stuff happening.
I think.
So your prediction is inflation's going to spike.
I'm going to go the opposite.
Me too.
Yeah, I'm with you. I think consumer spending is getting tapered. I think people are kind of, debt levels are really high, even like credit card debt, stuff like that. I think that people are not going to be spending the way that that would cause inflation to continue to print higher, regardless if there's higher cost for certain goods. I think that you're not going to have the demand from consumers that are going to drive up those prices.
So but there will be certain products that spike, like lumber from Canada, avocados from Mexico.
Yeah.
There's going to be certain things that spike. So there are, you're right. But I'm with Ben, and I'm making the bet that, how often do they report it? Every month?
Yeah, monthly.
So then I will say the next 3 months, my prediction is I think we're going to track roughly a 3% average monthly to get to a wrap up for the year. That's my prediction.
Your example is avocados. Okay. We grow avocados here. Well, in order to supplement that, we're going to have to grow more avocado trees. We're going to have to hire more avocado pickers. We're going to have to go through, and that takes time.
And they don't ripen. We won't have ripe avocados year round.
You know what I'm saying? Like, or the aluminum or lumber, or whatever it is, whatever industry it is, it's going to take time to spool up, to fix this. Now, the only thing there's other things outside of it, right? He's doing all of these big deals that are happening where there's large investment into the country, and we might see our GDP rise growth that outpaces it to where it saves it. but I don't think it's going to happen quick enough. I think it's going to happen. I think he's going to have a great 4 years, but I think that the first half of his first year, I think he's probably going to see some issues with all of the change that's happening. So I'm voting inflation is going to go up on these reports at least once in the next 3 months.
Well, you're starting from a low ground. So I agree that it's probably going to bumble within 0.2 to 0.4.
Okay.
So do you think it's going to be more than that?
All I was saying was that I think inflation is going to go up and we're going to get a bad inflation report.
Pin a number on it.
I'm going to say that we're going to have a 0.5 point to a full point inflation spike, just so I can draw my red line in the sand.
There you go. All right.
Yeah.
I don't think we're going to have
maybe an annual average of 4.
Yeah, exactly. Like you were going to see something like we were seeing in 2022 or whatever it was, where it's like, oh my gosh, the inflation is going up. Because right now it seems like there's a little bit of a cap on it and it's starting to stay sticky.
I think that people are moving stuff.
Yeah, I don't think so.
Well, okay, inflation just dropped. Okay, it was one of the first good inflationary reports. But the tariffs went into effect like last night at midnight. Like, what are we talking?
They haven't yet. They're going into effect on the 20th.
Some are in effect today. Steel and aluminum.
Yeah, so
25%.
It hasn't even happened yet. We're talking like it's going to happen. So that's my call to make it here.
Fair enough. I like it. It's a good prediction.
I think though, I was thinking about this too. I think the market is going to continue to bumble, but sell off. And what will pick it back up is getting through some of the spring, summer tariff conversation. But I think what will happen is the market will pick back up once the Trump tax bill gets extended. I think that's where you saw a lot of the gains when Trump got elected because of that, primarily is the taxes. And so I think that we're going to continue to sell off. And then once that gets, approved and probably the Q3 latest, right? In Q3, then I think you'll start to see
That's an excellent point. Every good old boy in a construction business is going to be buying a new truck, getting some new tractors. Planes are going to start selling again. So like at that point, like I think that's the break loose moment.
I agree.
For us, like heavy demand on supply.
Once a conversation changes off of tariffs onto the new good thing that he's doing, I think that we're going to see the markets relax.
Yeah.
But right now, all that anyone can talk about
I actually think that is the inflation moment. When things get moving again.
Yeah.
Because like today's kind of an unprecedented low.
Well, hold on. Let's just take this. Okay. Let's just take it like this. What's the tariff that we're seeing on vehicles in Mexico? Let's just say it's a 10% tariff from a car from Mexico. Okay. Just use this as an example. That tariff gets collected at port of entry. Okay. And it's going to Honda. It's already been bought. Well, in order to pay that today.
Yeah.
Now that car, if it was a $100,000 car, just for easy numbers, now it's $110,000. Okay.
Right.
So it's an immediate inflationary thing that's going to happen from tariffs.
So, okay, this is actually just a place of ignorance then. When do we calculate the inflationary moment? Like, how do you...
We'll hear it.
Like in this hypothetical, that's a great point. But then my point is that car sales are down.
Correct.
So you're not moving the amount of volume.
So what do you have to do?
Like, how do you measure that?
Well, then, yeah, exactly. So then I'm with you because I believe that people are going to be buying as many cars. So those are sitting on the lot. So what do? You start having sales. You start reducing the price of that. The dealership will eat that tariff cost or whatever that is, right? That's what I think is going to happen. I think that people are not going to be spending as much right now. One, because I don't think they have the discretionary income to do so. But two, it's because of all this uncertainty. They're seeing the stock market go down. Their overall net worth is down. They don't feel as rich. So they're not going to spend as much. They'll change options. There's a lot. People have options as well. So it's not like
you have to go buy a Hyundai.
Exactly.
Hyundai is made here.
Yeah. So I think that is what's going to happen. I didn't know that either.
Yeah.
Huh.
Yeah. Hyundai did like some interesting things. Super fun fact, but they like control their chips and they control their US based stuff is all like built in different states.
Nice.
Yeah.
We have an investor that owns a Hyundai here.
Yeah. He's the one that told us about, about that. They were the only ones that had chips when nobody else could get chips. It was really interesting. But so that's what's like, we're not going to buy manufactured homes if they spike again, like they did. We're going to be putting in RV plugs and then weathering the storm and then buying homes when they normalize.
Yeah, because you know what the price is going to be.
So then does that inflation occur if the products don't move?
No, I think it'll bring it down. Definitely.
But the company still had to pay for it.
But we didn't buy it.
But that company still paid for it.
They're not buying the lumber if we're not ordering homes. Like the volume comes down.
Yeah, but some of these are happening now. The product's already made and it's already been purchased. And now at port, they're getting hit with the tariff.
Right. So then they have their margins shrunk.
Yep.
Yeah.
So in that moment is my point. So like their margin shrunk on that batch, let's say.
Yep.
So then if demand continues, I'm with you. If demand halts or slows, then they're going to basically not be selling the volume. And so then the inflation doesn't really hit the same. It hits short term, but also they could just take a loss on those homes or like if they're making 10%, they only made 2%, whatever it is.
And earnings go down. And so the stock market goes down. And all, I think that's what we're saying is that and Trump kind of confirmed that on Sunday. I think that's why it's selling off, is that he's not so concerned and believes that there's going to be short-term pain. And I think that we need it, because my biggest fear.
Well, 50-1 PEs, price to earnings ratios, like that's crazy.
Yeah.
If I was Trump, I'd be like, dude, I'm totally down to hit this beehive.
Exactly. Yeah. And like, yeah, so Nvidia now they've sold off. And so it could be, if you're like, hey, maybe it's a good time to buy in because you believe in it long term, but it could sell off even more. And we'll see. You're seeing, I know these are a week delayed when we post them, but the market's tech stocks are rallying a little bit today. The Dow's down.
Because tech kind of had a nosedive moment.
Correct.
Yeah. So then everyone's buying the dip.
Buying the dip.
Yeah.
Yeah. But if it sells off again, it's that falling knife scenario.
I don't think we're going to have too crazy of a falling knife error. Like, I don't think it's going to continue throughout the week. I think that we just had a blip because of that conversation. Everyone got all spooked, which is so ridiculous. Mm-hmm. If you listen to the interview, this guy's giving interviews 24/7. The guy works like 16-hour days. And it's like one sentence in a 2-hour conference. And it's like, stocks are down. It's so crazy.
I feel like though, everyone's like climbing the ladder perpetually. And in their minds, they're like looking down, what these valuations are historically crazy.
Yeah.
To where like everyone's looking for a moment that's going to break it. And the house of cards is going to start falling. So the market's really fickle.
That's a great point. Yeah. When you're at such unprecedented highs with such high valuations, any little bit of news, just big sell-offs, because any little thing.
Buy trailer parks, folks.
Yeah, exactly.
Yeah, we just went to a industry event. So we go to only a few a year that are specific to manufactured housing, and so we're able to kind of test market, continue to grow relationships with brokers. The strategic relationships with current owners of big portfolios that may be wanting to sell off some of their product that would be in our wheelhouse. So we go to build relationships, but also we get to ping the market on a lot of the institutionally backed investors and acquisition guys are there. So we get to have fun with that and have a bunch of conversations, and we get to nerd out in trailer park land essentially. And so it was a really good. This was called Texco. It was in Houston. I hadn't been to Houston, and so Tide and I went, and we roamed around a little bit, looked at a few deals. We're long-term interested in the major metropolitan areas in Texas, and so we're just learning. So far we've only entered the Dallas-Fort Worth metropolitan area, which we continue to kind of like more and more. And but the overall sentiment was there's more capital being formed right now than I think ever before. Several institutionally backed parties are hunting aggressively for good, clean manufactured home communities that are city services, in major metropolitan locations. There's a ton of money in the space. So we are continuing to be bullish on the long haul, on the rent growth that's probably going to occur. And I'd say the amount of demand for these communities is going to hold a very firm, and or consistent cap rate, just depending on the macro and treasuries. If interest rates swing wildly, then cap rates will kind of tail that. Mm-hmm. But still, last year we sold a deal for in-place numbers, in-place collections for a 4.25 cap. And that's a really aggressive cap rate for interest rates being in the mid 5s.
Yep.
Mm-hmm.
So that's kind of, the overall global picture. So you guys want to add anything?
Yeah. Well, something from our trip that I kind of want to touch on that I thought was really interesting is I've been going to these conferences and going out to dinner with different groups for 10 years. And what it usually is us, maybe one other person at a dinner of 30 people. The rest are always aggregators from big companies. They're analysts. They've been sent by their corporate team to see if they can find deals and to meet and greet with brokers. But they're analysts driven on buying deals, and most of the time they're never going to trade. I just noticed at this dinner for the first time ever was private LPs. A guy who all he does is invest in mobile home parks, and another who has a handful of mobile home parks and has decided to transact them so that he can take the money and invest them in groups similar to us, which is pretty unique. Never seen that before. So I don't know if that means our space is becoming more widespread and the returns have kind of proven themselves over the time period, but it just was something that I thought was interesting.
Well, and it seems like people have learned over the last cycle, 5 to 10 years, that these mobile home parks aren't as easy to manage as they were originally kind of sold to be.
Yeah.
So there was a lot of like, everyone that's really good at it is still in the game. There's a couple of new characters that are good, but the rest of people are kind of like, there was a couple institutional guys that had completely gone through what would you call that? A reorganization on their, like the mobile home parks passed on to these guys that we met versus the multifamily that was in this fund got shifted into another. And so like the fund kind of evaporated and had to be divvied up because of performance issues. So there was a lot of changing of seats in the game. And I'd say it's like the professionals are the ones still in. And then there's like some deals that are coming around and being sold off where they're still good deals, but they were bought at all-time highs with interest rates at 3%. And they aren't owned and operated at a sufficient level. So it's causing some changes to occur.
Well, hopefully that means more deal flow for us, because you talked about the cap rate resiliency, I guess, if you will, that cap rates are still, in the 5s for us. Maybe depending on the deal, it could be sub 4s, because there's just not a lot of deal flow because people don't want to sell great deals because they're hard to get, they're hard to replace. So hopefully what that does is it shakes loose some of the folks that aren't able to, they overpaid, they got, either floating rate debt or they got, really low interest rates that was kind of saving them at the time.
Or they took 5 or 7 year term paper. So
that's what I mean. It's coming up for refinance.
Yep.
Or bridge debt.
Yeah. And now they were going to be looking to sell because deal flow for us has just been so challenging. It's what I always talk about, is that it's very difficult to get your hands on strong deals. And that's why relationships matter so much in this space, especially because there's no new supply. You actually have supply that goes down every year. And so it would be fantastic to start to see some deal flow, some deals break loose where it would allow for us to continue to buy into these deals and be able to take our professional management and then bring it up to the next level at a price that makes sense based on current market fundamentals.
Yeah. I mean, we're already kind of seeing this happen. Last year was a slow year for us, but towards the tail end, we saw a lot of deals flash out. And I mean, we've closed and are close to closing 3 deals in the last 6 months, which is great pace. And we aren't even into deal time. Like spring is where we're going to see a lot of deals. I feel like most, it's kind of like a pyramid shaped deal cycle flow. Usually Q1 kind of quiet, Q4, nobody's trading deals during the holidays. So it kind of all comes to a head in the middle of the year. And we're not even there yet.
Right.
So,
like most of the time brokers are working to polish their offerings that they're going to come out with in March, April.
Yeah.
And through the summer.
Yeah. And then you tie it up and it's, in escrow for 3 months with a couple extensions or whatever it is. And so, Q3, you kind of finalize your deals and that's it for the year. And so we're in Q1, we're about to finish our second deal of the year. And we had one close at the end of Q4. And so I think we're going to see, I think we're seeing that. I think we have a higher volume of deals flowing around. At least that's the feeling.
I couldn't agree more, especially compared to last year. Like there was just a lot of funk going into last year.
And I think too, with Treasury sitting where they're at, that is more encouraging for people that want to sell because they believe they'll get a better pricing than when the Treasuries were at 4.7, 4.8 Q3, Q4 of last year.
Yeah. The volatility, it's almost like your park's worth this much, interest rates affect it. Now it's worth 15% less overnight. And then now it comes back. It's like, it depends on where it's at that day,
Yeah. And I think just consensus of where treasuries, if they stay range bound, I think you'll see a lot more deal flow. But if they keep running, between 4.1 to 5 in 3-month spans, that produces a ton of uncertainty where people
you guys should be voting for
aren't going to be selling
my inflation numbers.
higher.
No, your inflation's actually creates treasuries to go up.
Oh, okay.
Unfortunately.
Yeah, but then wouldn't that potentially cause them to cut interest rates?
No.
Well, okay, yes, but only on SOFR, which is the Fed funds borrow rate, which is an overnight rate. And so SOFR and the Treasury demand isn't necessarily correlated. Over the long haul, it tends to be, but it's not a perfect science.
Yeah.
No, but yeah.
I just manage the trailer parks. These guys put the money together.
Well,
No,
I was
if
hoping that like if I think SOFR's at 4.25 right now.
Yeah, probably.
So
So because it ties usually the Fed funds rate.
If the Treasury was just holding at 4.25, I mean, we'd be fine.
Yeah.
It's the fact that like in October, we tied up a deal at 3.65 to 3.75 on the Treasury.
Yeah.
And then it ran up to 4.7 while we're in escrow. And so those are those moments where you realize like how volatile the treasuries are. And it all is based on why, how much demand from like the banks and governments are for US treasuries to hold them. So if you think if the people are going to go into more treasuries and they're going to drive the yields down, then you'd make money on them in essence, right?
Yeah.
Because then demand's up. But if demand drops off, you end up holding the bag and you have to hold the treasuries, which depending on how much you buy, right?
Right.
So I'd say the bank collapse of Silicon Valley and First Republic and those kind of regional business banks, that changed the demand probably indefinitely for treasuries.
For longer dated stuff for sure. And I think we don't want inflation to go up because if inflation goes up, then the Fed will be forced, depending on unemployment, will be forced to actually increase rates. Treasuries will sell off, yields will go up. So inflation is bad.
Yeah. I'm not voting for inflation.
Well,
I do think it's going to happen. But
so hold on. I think it's a really good point. So right, we're always doing deals, which I think is really important for any sponsor, somebody that's buying multifamily. Like you got to stay in the market, in the game, because we are forced to figure out how to best make deals happen, and we're not doing it with crazy debt levels where our loans are like 50% ish loan to value. To where what's interesting though, in about our space, and that's part of the reason why we focus on it so heavily, is we're voting no for inflation. Like all of us would love to see just a normal couple percent a year, maybe max 3% a year. But with that said, that just impacts rates. Mm-hmm. It doesn't impact our ability to raise rents, because demand is still there. So if inflation runs, we actually end up with a higher amount of demand and or a broader stroke of demographic that want to live in our communities because we're the most affordable.
In that, yeah, and it's also just real estate in general. And real estate is an inflation hedge. So as inflation goes up, rents go up, prices of homes go up.
Long-term multifamily will continue, but it's just stalled out at the moment.
Yeah, and it's really the difference between what someone is willing to sell for versus what someone's willing to buy for based on where interest rates are and where you can peg your loan at. And those three combination is what's kind of stalled transaction volume. But if you have sellers that have to sell or need to sell because they're coming up on their deal cycle or they're coming up against a refinance or loan expiry, then they become not necessarily a forced seller, but they have to then close that bid-ask spread between what buyers are willing to pay for and what you're willing to accept. So that's what I really hope comes through this year, and we just see some more transaction volumes. We didn't see really anything last year. So I'm hopeful with you guys that we see a ton of deal flow, and it really can give us a sense of where the market is currently for our existing deals and then, our future deals.
Yeah. And when loans don't shape up well, but people, like you just said, still need to do deals and have to transact, we do seller carry deals with people from time to time that are really beneficial to our investors.
Mm-hmm.
Yeah, we can then have fun with the loan terms and spell it out. And that's why you have to be in the space and active, because when that shift happens, you have the argument to make the pitch to a seller. And I mean, we know of some really great institutional deals that got done and they got to their IRR, I'd say target / goal with seller carry, you know, and so if you're not doing deals, you don't know that that's happening. Mm-hmm. And so it's important to just stay in the game. And
you can tell who's not in the game. Sometimes we have conversations with owner operators and they're like, they have these expectations that are like 10 years old. Their evaluations and
when rates were at, when Treasuries and SOFR was at 0 and they were, we were getting 3% rates and they want that value.
Yeah.
It's like, sorry, we'll call you, in a couple of years when your loan matures. So yeah. Well, hey, thanks for joining us today. We had a lot of fun sharing our thoughts. Obviously we are not professionals in this. We just have a lot of fun. We do pride ourselves though as being very active in manufactured housing, and we'll continue to do so. So thanks for joining us on another episode. CashFlow Quest.